With the U.S. election now behind us and a new year quickly approaching, many fixed income investors are curious as to what the road ahead has in store for fiscal and monetary policy and what that could mean for returns. While weighing the risk and opportunities in 2025, the question that keeps coming up is, how should investors position themselves? We will break it all down for you right here on UBS Trending. Hi everyone and welcome to UBS Trending. I am your host, Ann Cassidy, joined today by Leslie Falconio, Head of Taxable Fixed Income Strategy for the Americas with UBS CIO, joining us to break down the latest news within the fixed income space. We'll talk about the economy and Fed, so a lot to get to. First off, Leslie, it's great to have you here back at the table. Thank you for spending some time today with our viewers.
Appreciate it. Thank you.
So, Leslie, at this point, as we're speaking, we're about a month or so past the U.S. election. We did have a GOP sweep, of course, in the White House, as well as within both houses of Congress. So can you speak a bit to how fixed income markets have reacted since the election?
Sure. And I mean, what's interesting about that, Dan, is that most of the betting markets, as we know, were predicting sort of like was Trump as a winner and potential red sweep even prior to the election. So you had a lot of these Trump trades already priced in. And, interesting, since the election, right, we've seen 10-year yields actually come down. For the month of November as a whole, 10-year Treasury yields are down about 20 basis points. We've seen interest rate volatility come down. And we've seen things like spreads, like risk assets, overall start to compress or sort of stay range bound. So a lot of this has to do with the fact that it was really already priced into the marketplace. Now, as we know, or as we don't know, what exactly these policies are going to be in terms of timing, implementation, sequence. So while interest rate volatility is lower, right, in the month, we're not convinced that that's going to hold. But we have this sort of invisible line in the sand for 10-year Treasury yields. With right now, we saw about a 4.5% in terms of that upper bound. So we'd say about 4 to 4.5% at least for the short term.
So I think back to 2023, picking up on the 10-year, back in October of 23, it was around a 5%. As we made our way closer to year end, this time frame came down to around the 3.8%. So as we now look towards the back end of 2024, where do you see the 10-year yield heading from here?
Yeah, that's a great question because, we've had some lately. Some of that City Economic Surprise Index has come down a little bit. I mean, the economy is still strong, but it's showing a little bit signs of softening. So that's one of the reasons why 10-year yields have gone down as well. But from now to the end of the year, when it comes to, we have, one Fed meeting, we have, non-farm payroll this Friday, which is expected to be, 225. It's supposed to be higher given what we saw in terms of the previous month because of what we saw, hurricanes and the Boeing strike. So, and we might have an inflation number too. So it's not like that you have a lot of fundamental data that's really going to alter the course of 10-year Treasury yields from now to the end of the year. So it's really going to be based on how people view, policy and implementation. I mean, one of the things that I will say that we do have is in the December FOMC meeting, we do get a new SEP projection, so summary economic projections. And as you know, our CIO house view is for a 25 basis point cut in December and 100 basis points for 2025. And right now, that's exactly the median dot plot that we saw from the September summary of economic projection. December, we're going to have a new one, and the market's expecting that you could have a little bit of a hawkish tilt from Chair Powell, and he might start to remove a bit of those cuts that were priced in, given the fact that although you don't have the data, although we don't know what the policy implementation will be, we have stronger growth and inflation, while not skyrocketing, has really trended down very much. So I do think that from now to the end of the year, we'll probably stay in this 4 to 4.5% range. I would be surprised if we go under 4% unless we see a true weakening in non-farm, but that's not our expectation right now.
So I do want to ask about mortgage rates. As you mentioned, the Fed has commenced. We're in progress with respect to the rate cutting cycle. We're expecting a 25 basis point cut at the December meeting. Are mortgage rates coming down as quickly as potential buyers perhaps would hope? What are your thoughts on the MBS market?
Yeah, I mean, listen, the MBS spreads have started to come in because volatility has started to drop. And one of the components of the mortgage rate is not just, where's the 10-year Treasury yield, but it's also what we call that mortgage spread. That's one of the drivers of the 30-year mortgage rate. So that started to come in, which should help in terms of bringing that mortgage rate a little bit lower. But honestly, Dan, at the end of the day, we were at a situation where, given the level of 10-year yields, the mortgage rate's very high. And part of this is because we've had this inverted yield curve for such a long time. Part of it's because we have supply and demand imbalances. Consumers have locked in an effective mortgage rate at 3.8%. So when we think about the mortgage rate going forward, it's really going to be interesting. And this is really one of the things that we look for in terms of possible variables to growth and the outlook for 2025 is that, we think about these bond vigilantes that always kind of rear their head, right? Every time we talk about the deficit or those that don't believe the Fed should be cutting because it might reignite inflation, we always look at that back end of the yield curve. And you really have to watch out to make sure that that back end doesn't go up too much or that mortgage rate doesn't skyrocket again, because that's going to be a headwind. And I think that's something that definitely the Fed watches. I think that's something that obviously the consumers watch. So while we look into next year, I would love to say that we're going to see this really large decline in the 30-year mortgage rate. Probably not. You're going to be lower, maybe by like 25 or 50 basis points from where we are now, but we're not expecting a huge amount of yield decline in 2025, right? If we have a 4%, in 10-year Treasury yields likely for 2025 at the end, obviously it's not going to be a straight line, but they're probably going to be at or around where we are today, maybe lower, but not, materially.
So a lot of considerations when you think about the upcoming changing landscape in Washington combined with monetary policy as we're heading into year end, Leslie. To pinpoint it, what's one thing fixed income investors should be mindful of?
What's interesting is that, listen, volatility, while lower right now, it's not, we don't get too comfortable, right? Because we don't know what the implementation is going to be, what the sequence is going to be. We don't really know yet. Everyone's very comfortable with whatever tariffs might be. It's a point of negotiation. Don't take him literally. Take him seriously, but not literally. So I think there's that comfort level there in terms of let me get this yield and get this carry, which we agree with as well. But I do think that what you see in 2025 are those asset classes that lagged in 2024. Municipals, agency MBS really start to do a bit better in 2025. And in fact, Dan, if you look at November for a perfect example, munis were the top performer, right? Total return at 1.6. MBS was the second, and they are starting to see some inflows into these funds. And I do think that those sectors that lagged a little bit in 24 will really do well in 2025. But again, there is still a lot of unknowns that have to play out. Besides the Fed path, and besides really how the impact is going to be to the overall growth into the economy, there's just a lot unknown. So we want to stay diversified. We want to keep it higher quality. But more importantly, when it comes to U.S. interest rates, more important in 2025, you have to be tactical because volatility is not behind us. So we expect some volatility ahead.
Well, Leslie, thank you for all of your insights and your positioning guidance, not only today, though throughout the course of 2024, and do look forward to further conversations in the year ahead.
Thanks, Dan. I appreciate it.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, including LinkedIn, Facebook, Instagram, and Twitter, and check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with your UBS financial advisor. Until next time, I'm Dan Cassidy. Have a great rest of your day, and remember to keep your eyes on what's trending.